Welcome to FinSights Daily by Finvestin, where we cover the daily updates from the world of finance that impacts your day-to-day life. I'm your host Narendran. Quick reminder, play this episode at 1.5x for a better experience if you are short on time. In today's episode, we are going to cover three important aspects impacting the Indian economy and markets: trade tariff war declared by the US, crude oil price, and the RBI monetary policy updates. The gloves are off, folks. President Trump just dropped what many are calling as an economic bomb, a jaw dropping 104% tariff on Chinese imports. That's not a typographical error, that's 104%. Double the price of Chinese goods entering American shores. This isn't just a policy adjustment, it's the economic equivalent of throwing down the gauntlet. And China, they didn't blink. Within hours, Beijing fired back with an 84% tariff on American products. Let that sink in. Products that American businesses were selling to China yesterday will now cost Chinese consumers nearly double. The economic chess game between the world's superpowers has entered a dangerous new phase. But wait, there is a third player entering the arena. The European Union just announced plans to slap 25% tariffs on American goods, ranging from Kentucky bourbon to Silicon Valley tech. The global economy is now caught in a three-way crossfire that's sending shockwaves through every market in the planet. What does this mean for your wallet? Let me paint you a picture. The smartphone you have been eyeing, its price tag just jumped by nearly 50% overnight. The clothing retailer down the street, they are frantically recalculating their pricing as we speak. Even your morning cup of coffee could soon cost more as global supply chains buckle under the pressure. Let's zoom in on India, which finds itself in a fascinating position as these economic titans clash. Imagine being the kid who watches two bullies fighting in the schoolyard. There's a danger, yes, but also opportunity. That's India right now. Indian textile manufacturers are suddenly fielding calls from American retailers desperate to find alternatives to Chinese factories. Pharma companies in Hyderabad and Mumbai are seeing their order books fill up as US hospitals worry about their Chinese supply lines. But here's the twist: India's booming electronic sector relies heavily on Chinese components. Visit any smartphone assembly plant in India, you will find it packed with parts stamped made in China. Those parts just getting a lot more expensive. Meanwhile, India's government is walking a diplomatic tightrope, publicly expressing concern about global trade disruptions while privately positioning Indian industries to fill gaps in global supply chains. It's economic opportunism masked as diplomatic neutrality, and it's an absolute brilliant strategy if they can pull it off. What should you do with your money in the keys in this chaos? Anyone who claims they know exactly how this plays out is lying. The smart money is diversifying across sectors and assets that might benefit from this reshuffling of global trade. For everyday consumers, the advice is more practical. That that major purchase you have been considering, the price tag is only going up from here. The consensus among retail analysts is that we are just seeing the beginning of a price adjustment wave that will sweep through stores in coming weeks. As for how long this economic standoff might last, history suggests that trade wars aren't resolved quickly. With President Trump having campaigned explicitly on getting tough with China and Chinese leadership unwilling to show weakness, we could be looking at months or even years of economic brinkmanship. The stakes couldn't be higher. Goldman Sachs released a sobering analysis yesterday suggesting that if these tariffs remain in place for next 6 months or more, we could see global growth contract by nearly a full percentage point, potentially enough to tip the world into recession. Crude prices crashing to 4-year lows. In this segment, we are looking at the significant drop of crude oil prices. Recently, crude oil prices have plummeted to their lowest levels in over 4 years, with Brent crude falling below $60 per barrel and US West Texas Intermediate dropping to around $57 per barrel. But how does this affect the people in India? Here is the breakdown. The good news are reduced import bill. India imports about 80% of its crude oil needs. A decrease in global oil prices translates to substantial savings on our import bill, potentially around $13 billion. This reduction can help narrow our fiscal deficit and strengthen the rupee. And the next news is lower fuel prices. With crude oil becoming cheaper, as yesterday we spoke about the crude oil minister telling about the reduction in oil prices that might get implemented in the coming months. So, directly reducing the fuel cost that we incur on a day to day basis and controlled inflation. The lower fuel prices can help keep transportation and manufacturing costs in check, contributing to overall price stability. The Reserve Bank of India has projected a moderation in inflation rates partly due to the decline in crude oil prices and improved corporate margins. Industries that rely heavily on petroleum products such as paints, plastics, fast moving consumer goods may experience reduced input cost. This reduction can lead to improved profit margins and potentially lower prices for consumers. And there is not only good news, there is also bad news from this crude oil price drop. The drop in oil prices is largely attributed to escalating trade tensions, as we spoke in the previous segment. These actions have fueled fears of a global recession, which could dampen demand for Indian exports. And there will be a stock market volatility. Energy companies, including major players like Reliance Industries and Indian Oil Corporation, may see their revenues impacted due to lower crude prices. This scenario can lead to increased volatility in the stock market, affecting investor sentiment. While the decline in crude oil prices brings certain advantages to the Indian economy, it's essential to remain vigilant about the broader global economic context as investors and consumers. Staying informed and adaptable will be key to navigating the opportunities and challenges that lie ahead. The RBI has just dropped some major updates during these turmoil times that could reshape your financial landscape from your home loans to your saving strategy. So grab your coffee, pull up a chair, and let's decode what these policy shifts mean for your money. First up, and this is huge, the RBI has slashed the repo rate by 25 basis points, bringing it down to 6%. But wait, what does this actually mean for you and me? Think of the repo rate as the financial word's thermostat. When the RBI turns it down, the cost of borrowing cools off across the economy. If you are paying EMIs on a home loan, this could be your lucky day. Those monthly payments might just get lighter in the coming months. And if you have been fence sitting on taking that home loan, well, the timing just got better. But before you start mentally redecorating your dream home, remember that your bank needs to pass these benefits on to you. Not all banks move at the same speed when it comes to rate transmission. So keep an eye on your bank's announcement in the coming weeks. Moving on to our second game changer, the RBI has shifted its monetary policy stance from neutral to accommodative. Now, I know that sounds like a financial jargon, but stay with me because this directly affects your wallet. An accommodative stance is essentially the RBI saying we are ready to take money cheaper if needed. It's like the difference between your dad saying we will see versus yes, probably when you ask for something. The chances of getting what you want just went up. For you, this signals the financial environment for borrowing isn't just favorable right now. It's likely to remain that way for foreseeable future. If you have been planning major financial moves like buying a home, expanding your business, or even taking an educational loan, the stars are aligning in your favor. Our third important update is The RBI has revised India's GDP growth forecast for financial year 26 downward to 6.5%. That's a 20 basis point reduction. And while 6.5% still represents robust growth, the RBI is essentially acknowledging that global trade tensions and domestic challenges might tap the brakes on our economic momentum. What does slower growth mean for you? It's signaled to be more strategic with your career and investment choices. Job markets might become more competitive, salary hikes might be more modest, and businesses might be more cautious with expansion. Don't panic, 6.5% is still healthy growth, but it's a good time to build your emergency fund, upskill yourself, and diversify your investments. Think of it as a putting on your financial seatbelt, not because it's going to be a crash, but because the road might be get little bumpy. And fourth on our list, inflation is projected to remain stable at around 4%. This is actually great news for your household budget. Stable inflation means the prices of your daily essentials won't shoot through the roof unexpectedly. Your morning chai and vegetables shouldn't see a dramatic price hikes. For savers, this means the real value of your money isn't being eroded rapidly. For investors, stable inflation creates a predictable environment for making investment decisions. Smart investing is still crucial to stay ahead of inflation. And finally, our fifth major announcement, the RBI has proposed six new regulatory measures targeting banks and fintech companies. Now, this might sound like it only affects financial institutions, but these regulations will directly impact services you use daily, from UPI payments to gold loans. Take gold loans, for instance. Currently, if you pledge your gold jewelry for a loan, different lenders might offer vastly different terms. The RBI plans to reduce uniform guidelines to ensure fairness and transparency, regardless of whether you approach a bank or an NBFC. These regulations aim to protect you and me, the consumer, while ensuring the innovation in financial services continues in a sustainable manner. The RBI is actively seeking public feedback on these draft guidelines. So, if you are a borrower, there is probably the best news you have heard all week. The rate cut combined with accommodative stance suggests that the cost of borrowing could decrease further. If you are on a floating rate loan, you might want to check with your bank about when they will be adjusting your rates. For savers and investors, the stable inflation looks a clear benchmark for your investment returns. Any investment that doesn't beat 4% means you are losing your purchasing power. And for entrepreneurs, while GDP growth forecast has been trimmed, 6.5% still represents significant economic expansion. The accommodative monetary policy should make business financing more accessible, potentially offsetting some of the broader economic headwinds. From tomorrow, the earnings season starts. That is nothing but every company starts to announce their results for the last quarter and the last financial year. So, based on the trade wars, crude oil prices, and this RBI monetary policy changes, the upcoming months is going to be a very volatile times. So, make sure you save and invest in a wise manner. Well, that's all for today's Insights Daily. Thank you for joining me. This is Naren signing off. I'll see you in the next episode with fresh updates from the financial world. Have a wonderful evening and remember, stay financially savvy.